Hey everyone, in today's video I'm going to give a very brief introduction to the Fama-French three-factor model, which is one of the most famous and well-known factor models. Uh, just what is a factor model to begin with? A factor model is just a mathematical finance model that uses what we call factor loadings to predict the future value or growth in a specific financial investment. And I'm gonna, clearly it should become a little bit more obvious as we go through this video what I mean by that. But I want to start with the very most basic factor model that finance uses, and it's called the capital asset pricing model, or the CAPM model. And this is the formula for this CAPM model right here. So really easy. Basically, what the CAPM model says is that the required stock return, little r, is a function of the risk-free return rate, which most finance investors use is the 30-year Treasury bond yield, and then the market rate of return, and they usually use the S&P 500. So the very last term that is needed in the CAPM model is this beta term. And the formal definition of beta, you don't really need to know, but it's equal to the covariance between the return rate on a stock and the market rate return over the variance in the market. So you can really just deduce this down to just saying that it's a measure of how closely a stock or investment tracks the S&P 500 or any other benchmark that you're trying to compare it to. So that means that a beta of equal to 1 moves exactly with the S&P 500. So if you were to invest in like an S&P 500 ETF, that would have a beta of 1. However, if we have an investment with like a beta of 2, for example, that means it is twice as volatile. And this all goes in to say that you have what we call the risk premium right here, and the required return rate is equal to the risk-free rate plus the correlation with the risk premium that is required by the market. So let's use a simple example. Let's assume this beta of equal to 2, so a super volatile stock, it's twice as volatile as the S&P 500. Then we're going to use the current approximate risk-free rate of 1% and the historical S&P 500 annual return of 10%. So we're looking at a 1-year return in this case. So then we would get a risk-free rate of 1 plus 2 the beta times 10 the S&P 500 return minus 1 to get a return of 19%. So what we're saying is the required return for a stock with a beta of 2 given these inputs is 19%. Now, super easy formula, conceptually makes a lot of sense, but it's not very good at predicting market returns. But it gave us a good benchmark for starting these factor model investing. So Eugene Fama and Kenneth French received the Nobel Prize for the Fama-French three-factor model that they developed in 1972. And so all that they did is they took the CAPM model, which you can still see is in their formula, and then they just added two additional what we call factors, as well as they introduced a constant that changes the slope. So that we're saying that there's going to be some sort of guaranteed return beyond the risk-free rate. And so, what does SMB and HML stand for? Well, SMB stands for small minus big, and HML stands for high minus low. These are going to be the two additional factors that make up the three-factor model, and they incorporate two very important historical facts. First, that small cap stocks typically have higher returns than large caps. And so this SMB factor just measures the excess return. And this can be numerically calculated by just sorting small stocks and seeing their excess return compared to big stocks. And then all that you need to do to get this BS term is just look at the cap size of your asset. Now, additionally, you have this HML term, which stands for high minus low. And this is based off the stylistic fact that stocks for companies with high book to market ratios. So we're looking at the ratio between the value of assets a company has and the market price of a company. These companies with high book-to-market ratios do better than the ones with low book-to-market ratios. And HML is just, once again, this factor that measures the excess return. So all you really need to do is figure out these factor loadings, which is just where the potential stock fits in the formula. Now, this sounds pretty hard, but luckily, Kenneth French actually automates all the data collection for every single stock that is publicly traded here in the US, and he puts it on his website, as well as he puts on the current factor loadings for the market risk premium, SMB, and HML. So if you're ever interested or want to invest based off of the three-factor model, you can just check out his website. It's really easy to follow and see what these factor loadings are. And you have to be like, it can't be that simple, right? Well, that is true, but in a long-term study, Fama and French have found that their model fits the data with 95% accuracy. So what we're saying here is 95% of long run returns. So we're not talking about like day trading or arbitrage profits, etc. We're talking about over long periods of investing. So this has been done on a characteristic time scale of 30 years. Uh, they found that their model fit the data extremely well. And, there's a lot of economists and financial experts that debate about whether or not this is because of market efficiency or market inefficiency. Should this be a truth that small cap stocks typically have a higher return than large cap stocks, or etc.? It's left up to further discussion and up for all of us to decide on our own. But there is an undeniable fact that the Fama French three-factor model actually tracks the market quite well, which is why they won a Nobel Prize for this. But yeah, it's just a fun little model. They actually have increased this in 2015. They introduced the new Fama French five-factor model, which introduces a couple of additional factors. So if you're interested, you can go ahead and check that out or talk to me about it. I'm happy to talk about this more with you. But other than that, this is just, a nice little introduction to modern investment uh, guidance on what a factor model looks like.